Will the housing market in the United States crash in 2022? According to data from Freddie Mac, the outbreak caused a dramatic increase in the value of residential real estate. People will raise the price of their houses as a consequence of a combination of low mortgage rates and limited supply in desirable regions, resulting in a rise of 1.3% in 2020 and 16.9% in 2021 in the national average. The rise in house prices will be less transitory than the increase in consumer prices because the housing market in the United States will continue to be constrained by a lack of available homes for many months longer than is now expected. It is true that the seller's market is an issue, but growing property prices, the availability of relatively inexpensive mortgages, and customers who are apathetic about cost are all factors contributing to the slowing of the housing market in 2008. Of course, the market circumstances are not precisely the same, but many people are asking if it is prudent to fall at this point in the cycle. Is a collapse of the housing market in the United States unstoppable? A number of variables, including supply and demand, make Andy Kaufman believe that the housing market will not collapse. In the short term, interest rates are at, and will likely remain at, historically low levels, even if rates rise by a percentage point or two, making long-term mortgage financing affordable. In the long term, due to a strong wage, first-time homebuyers or buyers would likely be eager to step in if prices begin to fall. Many of the industry professionals who answered to the Street's request for information about the prospect of a housing market catastrophe are likely to react again in the future. An economist from Niagara University has written in the Street that the fact that the stock market has not crashed does not always imply that prices will rise indefinitely. The demand for housing had evaporated during the Great Recession of 2008 to 2009 owing to the rising unemployment rate, whilst the supply/inventory/construction was strong with soaring expectations initially followed by massive defaults, according to the author. Because both demand and supply suggested lower prices, house prices declined/crashed to an unprecedented degree, says the author. Recommendations from the Street. As a consequence of the pandemic-related supply chain challenges, he stated demand for housing may be somewhat lower today owing to higher interest rates and inflation predictions, but supply of housing has also dropped due to higher labor and lumber prices as a result of higher labor and lumber costs. In other words, the demand side predicted lower interest rates, and the supply side revealed a different tale entirely. Additionally, the unemployment rate is slowly improving, which may contribute in stabilizing the demand side of the economy. So although there may be a downward trend in overall house prices, there will most likely not be a collapse as a consequence. Why the housing market is not the cause in 2008. While the year 2022 seems to have a lot in common with the year 2008 on the surface, certified financial planner Julian Morris explains why the reality is very different. When compared to 2008, this market is mostly driven by demand and supply. Younger families are increasingly relocating from urban areas to suburban areas. Although the rate of acceleration may decrease, there will be no quick fall until there is a surplus of additional homes, which there is not at this time. He sent a letter. People taking out adjustable rate mortgages and over-leveraging were the driving forces behind the financial crisis of 2008. They went into default, resulting in an oversupply. This time, though, things are different. People with fair to excellent credit might qualify for low-interest loans without the bank having to verify their income or assets. Consequently, a scenario has been created in which a large number of individuals are likely to default. As Melissa Powell, the president and chief executive officer of Apparel Premier Realty Group, pointed out, government-backed loans from Fannie Mae and Freddie Mac have likewise tightened their lending criteria. Due to a lack of readily available money for unqualified purchasers, the property market has gained a degree of stability and protection against a collapse that it did not have before the financial crisis of 2008. The market will continue robust as long as there are changes in the economy that result in an increase in defaults, or if lenders become lenient on their criteria, as happened in 2008, which is due to inventory-related factors. According to Christopher Avion, a real estate broker, supply is still quite limited, and demand is still extremely strong at this time. Supply is still quite limited, and demand is still extremely strong at this time. Don't just buy Bitcoin, you can earn with blockfi. When you spend with blockfi, you can earn up to 3.5% back.